Good evening, ladies and gentlemen. Thank you for joining us in our EastNet session, where we're going to be discussing artificial intelligence and technology in general as a method to help in combating financial crime compliance related to trade-based money laundering. And in particular, we're going to be focusing on a specific aspect which is related to mis-invoicing and in specific overpricing and underpricing. I'm Nasser Sweileh. I am a financial crime compliance expert at EastNet.
And I am Zied Smiri. I am an expert in trade-based financial crime.
So let's start with some challenges that trade finance operations people, as well as trade finance compliance people, face in their day-to-day work.
Yeah, so the typical way when we have a trade finance deal is unfortunately very paper-based. It's very paper-based because of the legacy of how it used to be done in the past. So documents come in, we need to check this document for authenticity, and then we need to check this document for consistency. So a document, they don't all come into the same time. As you're probably aware, a trade finance deal sometimes takes weeks or months, depending on the shipment, the type of merchandise. So these checks need to be manual. And unfortunately, because of the lack of standardization, it is a very manual process.
And that's not just the operations part, but also the compliance part. That is a big struggle because you basically need to screen the transactions, screen them against sanctions, PEPs, adverse media, dual-use goods, depending on what kind of processes you need to do, whether it is a transaction or it is documents. You also need to do the vessel tracking, which means you need to go and check where the vessel is going, which ports it's stopping at, does it turn off the transponder in the middle of the sea? Does it stop for a specific period of time next to another ship? You also would need to tackle what we call trade-based money laundering or trade-based financial crime monitoring. And that's the element that we will be focusing on in the coming slides because those typologies are of utmost importance and they are extremely difficult. And the problem is, Ziad?
Yeah, so as you can see, what we're trying to highlight here is the fact that it is first manual and really very fragmented. And what happens, it's really cumbersome for the trade finance compliance teams because of reasons that we will develop later on. But keep in mind that it is really manual and fragmented.
And the big problem here, remember, is that Ziad mentioned it happens over a period of time where payments can come at specific moments. The transactions, the goods can come, or the documents related to goods happen at a certain point of time. So the payments themselves and the goods, or the trade and the payments related to it, they are not always looked at, whether in terms of trade operations or trade compliance, in a consistent way, in a consistent manner that enables people to see a holistic view of things. So the hidden threats are in trade-based money laundering typologies. We mentioned in the previous slide that trade-based money laundering monitoring is extremely complex due to the complexities of trade finance. So we are going to talk about a specific type of trade-based money laundering, which is the mis-invoicing. So using the invoices in specific for activity of trade-based money laundering. And there are 3 or 4 that we would like to focus on. Duplicate invoicing, which means duplicate using the same invoice in multiple trades. Multiple invoicing, which means for the same trade, you keep sending multiple invoices, 3, 4, 5, depending on what you need, so that you would utilize those invoices in a process of money laundering through the trade activity. And the core one that we care about, which is over-invoicing and under-invoicing, where you utilize the price itself within the invoice to launder money. What does that mean? It simply says you over-invoice something that is cheap, which means you're sending the money inside the goods somewhere else, or you overprice something, which would mean that the money remains somewhere and the goods go somewhere else and the money is consequently moved somewhere else. The problem here with these kinds of typologies is
Yeah, so again, we come back to what we mentioned earlier, the fact that it is manual and that is fragmented. So the trade finance department or the compliance or the analyst that is working on this needs using the paperwork to identify which product we're speaking about, but most importantly, um, needs to identify the brand, maybe the quality of this product, the quantity. So there is a lot of information to gather from the documentation themselves. In addition to that, for the companies who have the luxury of having historical data, they need to retrieve it. But here again, it might be in a different system, it might be manual. So they need to retrieve this data so they can compare against it. Obviously, prices fluctuate, and even from a technical point of view, not all the prices are the same. We have retail prices, wholesaler prices, we have prices that include shipment, not. So the analyst needs to do a lot of work to identify which price point he or she is comparing against, and this is require time through research, either via the internet or any different way. Again, just because of the nature of the trade finance deals, they are international, and usually the currencies are different, so there is a whole work to unify the currency base that the analysts are working on, so they're not comparing apples and oranges.
What does that really mean? That means that this process that is extremely manual costs a lot for banks. It costs them in terms of trade operations, and it costs them in terms of trade compliance. 60% of the time on documentation because of manual processing and the consistency checks, because it's a purely manual process. 40% error possibilities when it comes to identifying the price, to identifying if there is overpricing, underpricing. And that would mean that the process itself can be delayed to up to 72 hours for the trade, which means extra cost and problems for the banks, because we're in an age where everything is trying to become instant, and definitely trade is way far from being instant.
And this is something that is really cumbersome, because the trade finance deal elapses over a long period of time, so some of the work becomes repetitive. What do I mean by repetitive is you receive the first document, you do your check, you spend the time, but then maybe the next document comes in after 1 week or 10 days. And when that happens, maybe it's not the same analyst that's available. If it's not logged within a system, then you need to redo that work again. And it becomes like an iteration of this same time that is being wasted over and over again and delaying the work. What we can see here typically, and this is the most important thing that we realize, is because of the silos and how we deal with the trade finance deal, sometimes within different departments, we would have persons looking into the trade itself, the shipment, the goods coming back and forth, or the services, and a completely different department that is looking at the payments. And because of this silos, we lose a lot of information.
So what should we do? Let's bring trade and payments together. Ziad, how can we do that?
So technology now is advanced so much that it allows us to do this. So technology now, of course, there is no magic wand, but the situation is we are in a position where technology is leading us in the right direction. So what we do, all the challenges that we have talked about them, there are solutions. Some of them optimal, some of them suboptimals, but the sum of all these efforts and the sum of using these advances in technology and taking advantage of this, and most importantly, taking advantage of bringing both the product and the payment together, gives an edge to anybody. It's a competitive edge that they will be able, first of all, to increase their operational efficiency, which is a huge competitive advantage to have, but also to comply with the requirement and to be able to combat any financial crime, because this is the space where most of it is happening.
Exactly. So let's go through a specific trade that we assume has within an overpricing or an underpricing typology, and see how manually, based on all what we've described, how it would flow. Ziad, you want to talk?
Yeah, so as you can see, this is really to drive the point that we said. So as I'm describing these steps, you will realize how tedious the process is. So we have our documents coming in. Again, maybe the first document arrived. I'm doing my manual checks. If they are logged into the system, it's error prone because I'm doing it manually. These documents, by nature, they're not standardized. There are many initiatives in the industry to try to standardize these documents. Unfortunately, it's not the case yet, which brings a whole complete issue of is this document authentic or not, with all the time that is needed to do that. Then the point that I mentioned earlier, I have the additional document coming in. So maybe I have my letter of credit, but then I have some shipping documentation. Maybe I have some customs documentation. All of them need to be checked and checked again. And because they don't arrive at the same time, this work is sometimes repetitive. So another possibility to lose processing time. Then, once we reach this step, as we described earlier, we need to perform all the compliance steps. So, for example, if I am able to extract the name of the persons who are involved into this transaction, I need to do the screening. So I can comply with the screening against the sanctions list. In addition to that, if the goods are subject or could be dual-used goods, I need to screen against them. And so many different screening that need to happen. But this is not a one-time operation. So remember, the trade deal is over time. So I need to do this as long as the deal has not been closed. So for instance, I can take the example of the vessel. If my goods are being shipped in a particular vessel, there are a lot of red flags to look at. Is the vessel taking the normal route between point A and point B? Is the corridor suspicious? Maybe the transponder has been switched off for a particular point in time. So many of these possibilities that we need to look at. But again, if the work is manual, it's coming back to the tedious fact of doing this particular deal. And then we can go and move on into the typology.
The typology, by typology, we definitely mean overpricing, yes, underpricing. And in that, we need to go and identify the product, identify the brand, identify the historical prices if they exist, check the prices online, and handle the currencies. The problem here is, in a manual process, all these are happening in different systems. You're reading the documents that are manual, or maybe you have something that digitized it to a certain extent, but you still need to compare the documentation manually. You need to go to your screening solution to screen against the sanctions and the dual-use goods. You need to go to another system to try to see if you can do something about the vessel tracking. I see you nodding your head, and I see the pain. We do feel it. And you go to another system for vessel tracking. So these are literally different solutions, sometimes even utilized by different departments that might not even talk to each other. This is the level and the weight that the people who are supposed to look at the full risk, the full cycle, are struggling with. So, our clicker is not that fast. Let's see the solutions now. Let's see what we can really do, what Eastnets, for instance, has been working on, what kind of technologies we've been trying to adopt, because technology is becoming much, much better in solving these problems.
Yeah. So now that we have highlighted the problem, and most of you who work in trade finance are aware of how difficult and how tedious this is, what we have done is within Eastnets, we work in compliance. We interact with customers all across the globe. And what we did is we kind of co-created with them. We listened to the pain point, we saw what technologies are available, and we combined that with the knowledge that we have in terms of compliance solutions. And then we brought all of this together. Our idea is, as I mentioned earlier, is to bring the payment from one side, the goods from one side, and to treat them as a single operation, as it should be, because that's the case. So, as I mentioned earlier, there is no magic solution that all of a sudden does everything. But the combination of all the improvement that we have been able to implement gives us a situation that is closer to a full automation of a trade finance deal.
And we've been able to implement and integrate, because there are multiple stuff that can work together to leverage the capabilities of technology for that purpose.
Yeah, absolutely. So coming back to the point I mentioned earlier for the documentation, previously or even nowadays, so most they would do the digitization, it's loaded into a system, and then maybe that's the state of the art, or that's what they have reached. What we have done is we combine this with what artificial intelligence brings to the table. So we have the OCR technology on one side, then we add a layer of natural language processing, large language model to try to grasp what has been digitized within the documentation and do, or at least make it easier for the analyst to identify the product, to identify the brand, and to identify any maybe red flags in terms of this product, which we will explain later. So once we have all this data that is checked automatically, then I have a whole wealth of data that I can use for the screening. And again, because it is automated and because it is loaded into the same system, it makes life easier for the department, because this trade finance deal, it doesn't matter if it lasts a few weeks or it lasts a few months. Within our system, it has a unique case that you are looking at it. So when a new document comes in, we remove that pain point that I mentioned earlier. I don't need to go and refresh my memory again. What did I see in the initial document to compare for consistency? Immediately when doing my screening, my OCR and capturing for the new document coming in, it's loaded and added to the same deal. And then I can automate my screening, I can automate the vessel, and of course we have partners so we can follow the vessel movement, and it's always loaded to the deal so I can see what's happening to the shipment.
The first element that Ziad talked about, so the first box related to digitization and document consistency checks for trade people. So this is literally the trade operations aspect of things, making sure everything is digitized, but also doing automatically the verification, the comparison between the different documents to make sure that what is in a bill of lading, what is in an invoice is identical. And if something is not identical, it has to be highlighted. So instead of a user going through the documents and reading them and trying to put a set or a pile of documents in front of them and checking, the system is supposed to be capable of reviewing all this information and just highlighting to you the suspicions, the risks, the concerns that you have. Imagine the amount of laborious work that is avoided by doing that. And then, after implementing all those UCP 600 checks, etc., he's talking about the compliance people. And in the compliance people, he's talked about one element, but we want to highlight, which is basically screening and vessel tracking, which is definitely important because it says, as he said, a continuous screening. With any change on the lists, with any change on the trade itself, you have to re-kick the process of screening to identify it. And usually, banks are trying to do it in a very manual way or trying to create some sort of schedulers that are not as impactful and efficient as having something that is designed from the beginning for this purpose. Then comes the big one, which is the topic of our day, the overpricing and underpricing as part of mis-invoicing or as part of trade-based money laundering, trade-based financial crime. In this, we said there's a lot of difficulties or a lot of concerns that the clients are having. The process is happening also in a very manual way, to go on Google to identify certain prices, to go to, if they have certain subscriptions, to certain lists that provide you with prices of commodities, to go and manually convert the prices, to go to another system of trade to identify a previous trade for the same product with the price of that product. And unfortunately, before they even can start doing this process, they need to make sure that they know what the product is, what the brand is. A lot of people count on HS codes. An HS code can tell you that this is a jeans, can tell you that this is a laptop, but it can't tell you what the brand is in details. Yeah. And there's a big difference between a Montblanc and a Bic pen. There's a huge difference between a specific car and another brand of a car. I'm not saying any brands. We are so sensitive about the brands of the cars. But there is a need for the investigators to precisely read every single detail while they're doing even the consistency check to check what the brand is. And that's where errors can happen. And I can give you a very simple example. The brand, the tennis shoes Adidas, they are priced in a specific price, and there's some sort of a counterfeit of it, or a different brand, called Adibas with a B. The difference is just one letter, and it is supposed to be 5 times less expensive. So the Adidas is 5 times the price of an Adidas. And if an investigator is just looking at the documents and just doesn't notice the fact that they are importing an Adidas and pricing it as an Adidas, that is a way of overpricing a product. And using technology can help you in both ways. One, because large language models can go deeply into the documents, understand what's inside your document, including the brand, or even beyond the brand itself, the model, the quantities that are being bought, and does it search in an automatic way. Again, you don't need to go and check or read the document, identify the brand, then go to Google and type something. The system is supposed to be automatic and to give you this operational efficiency and go to search. And if through its search, it identifies that, for example, when scrolling the web, that there are, scraping the web, there are basically two brands that are so similar in name, Adidas and Adidas, it will extract all the information it can find about both brands, and it returns them to the investigator. So imagine what's happening today with an investigator using such kind of a solution. Instead of going to 4 or 5 solutions, one by one, to identify the price, the calculator in front of them to do the currency exchange, or using a website where they're trying to do the currency exchange, another system for the screening the vessels, etc. All this information, finding the historical prices in your other trade system solution, all those things are collected through integrations, put in one report, and put in one location, one specific case manager for you to be able to look at it, to view it, and to do your analysis. We are not here to replace humans. We do understand that in trade finance, it requires expertise, it requires knowledge. But we understand that that knowledge of human beings needs to be utilized in the right place, which is investigating where you have a risk. So instead of wasting the time, the valuable time of an investigator in searching and scrolling the webs and extracting information, we are spending their time preciously on investigating the suspicious activities. And Ziad?
Yeah, so what we're illustrating here is, if you look at all the steps that we have described and how we use technology, most of them are basically not replacing the work of the analysts, but basically helping bring the data, avoid all the tedious, all the error-prone actions, and then bring the information to present it in a unified case manager. And here, as you remember what I said at the beginning, is the whole is much bigger than the sum of its parts. Like really, when we bring all the information in a unified system that tracks the deal from beginning to end, automates the screening when it needs to be done, the sum of all these actions free up time for the analysts, one, to increase the operational efficiency, which I am sure for all of you is a competitive advantage, especially with the volumes that are increasing in trade finance, but most importantly, to be fully compliant vis-a-vis of the financial intelligence unit where you operate, and also to help protect the financial system from being used by any financial crime.
And imagine that unified case manager that is saying a trade, just a number, a code for a specific trade, has under it everything that you need to know about this trade. Whether there is an inconsistency between a bill of lading and an invoice, or a hit on a sanction screening, or a vessel that has stopped in a specific port, or any of the trade-based money laundering and trade-based financial crime typologies that could match. Because it's not just overpricing, underpricing. We focused on this because this is one of the biggest and hardest issues that trade compliance people are facing, but there's a lot that is being utilized in trade. And we know for a fact that trade is the biggest way to launder money, although unfortunately it is one of the least that is being monitored, previously at least, because of the lack of technology to do that.
But we also, speaking to our customers, we see the trend. So the trend in terms of the economy, trade is increasing, so this is a consensus. But another thing is the regulators are looking at this right now. In the past, there was more focus on different areas, but we see more and more regulator focusing on the trade because of all the reports coming in and indicating that that's where the financial crime is happening, that's when the money laundering is happening. And you are probably aware that all the goods that are being shipped back and forth, in reality, a very low percentage, if I'm not wrong, I think it's around 2%, that is physically being checked. So if the financial institutions don't do this work, it cannot be replaced by checking all the goods that are going back and forth through trade.
So just to conclude on this, imagine the load when it is basically a bank that has thousands, tens of thousands, or sometimes hundreds of thousands of trades happening in 1 month. And imagine the saving in time, effort, and in the risk related to financial crime compliance when you go and apply a system that tackles things from the beginning, the real beginning of receiving the documentation, till the end, till the moment where you do the payment, execute the payment, and close that deal. Looking at all these things, the estimated total operational efficiencies is between 40 to 60%, depending on how much you've implemented of it, what kind of models you've decided and opted to utilize, and obviously the data that you have within your institution, the way your functionalities, your operations are working. We do have 4 more minutes, so if there's any questions, we're more than happy to take them now. But if not, let's talk. We're in stand J06, just across on the other corner of the rooms. You're more than welcome at any point of time to talk to us. We're here to help. If we can help in anything, we're there for that.
Thank you very much for your presence. Yes.
Thank you very much. How do you look at this in line with the UCP that says that banks do not deal in goods, we deal in documentation? To what extent, as a bank, am I to authenticate documentation? Should it be the responsibility of the system or regulators to do this, or mean the bank? That UCP clearly says that my responsibility is not in goods and documentation. Am I to authenticate documents?
Totally agree with you. So I was expecting these questions. So I think you're all familiar with the situation with the UCP 600 and the fact that they said, okay, we tell banks clearly that you're not responsible. But vis-a-vis the financial intelligence unit and vis-a-vis the regulator, if you look at it from a compliance point of view, when you have an audit, you need to show that you did what you can, to the extent that you can, to detect this. So for example, if I give you a document that is clearly not authentic, or if I send you a bill of lading that doesn't match an invoice, when you have an audit, the financial intelligence unit is not going to accept the UCP wording. And all we are saying here is we are protecting you from that, because the system will tell you that there is no consistency. The system will help you to report this to the financial intelligence unit, and then you as a financial institution are protected. No one has asked you to go to check the goods. You are absolutely fine, and you can continue on with your business. And in terms of risk, you knowing this, of course, it's up to you to take it to the next step to de-risk and not deal with this customer anymore, or not.
Should I throw UCP into the dustbin? Then
No.
It doesn't provide the safety for me as an issuing bank as
From a
contained in
compliance,
the UCP 600.
From a compliance perspective, no, it does not.
We should throw it away.
Yeah. Right.
Any other questions?
Thank you everyone for your attendance. We are in this hall as we said, and anytime.
Thank you.
Yes.